Section 5. Build Advanced Trading Algorithm. In this section, we are going to arrive at the climax of our course. We introduce the Scalpers Trading Strategy and also introduce a very important evaluation metric which is named Sharpe Ratio. In this video lecture, the introduction to Scalpers Trading Strategy, we introduce the basic of scalping algorithm and introduce 4 ways to apply the strategy, 4 different strategies based and inspired by the same technique, and also introduce Sharpe Ratio. Let's start by introducing the scalping strategy. Scalping strategy is very attractive to small investors because they are less prone to risk. It's also very attractive because it applies to the concept of high frequency trading by applying many trades and issuing many trades per day. Scalp trading is also advantageous because you are setting your targets to be very acceptable, and so your expected targets will be met very soon than you expect. Another advantage of scalping strategy is that there are a lot of opportunities that rise from observing the trends in the indicators you are applying. So in the next discussion, we are going to review 4 different scalping strategies. Each one of them has its different technique. The first one is scalp trading with an oscillator, in which case you apply only one indicator. This indicator can be the moving average, the autoregression. You can work on momentum, you can work on standard deviation. Whatever indicator, you will find the concept to be the same. So here on the screen, you have a chart made by TradingView. The chart lists the stock prices for Facebook, and then you can see the stock price, the closing price, indicated with the blue line, which is the moving average for the last 10 minutes. This is a very simple algorithm, and yet it has a lot of disadvantages because counting only on one oscillator or one indicator gives us a lot of false signals, and we lose the view of the future trend, and we only get a very short window of forecasting for the last 10 or whatever period you set for your moving average. So now we introduce the second strategy on our list of scalp trading strategies, which is scalp trading with the stochastic oscillator. In this way, we are applying not only one indicator but 2 indicators. For the example on the screen right now, we have the price again in the blue color, but here we have 2 indicators. The moving average on the short term for 10 days, and that is plotted in the red color, but also we have the moving average for the past 25 minutes, which is plotted in the green color. The next strategy on our list is the scalp trading with the stochastics and Bollinger bands. The Bollinger bands are sort of the volatility police. They are boundaries for the price. The idea in this strategy is that we are not going to count only on the predictions or the decisions signaled by the long and short term indicators, but we are going to put them in the frame or in the boundaries of the Bollinger bands. This is going to help us verify our decisions and make sure that we are not following the false signals but only following the true signals. So on the screen right now you can see that we have a very complex graph, a lot of noise, but that's very simply the Bollinger band and 2 signals of the indicators, the moving average of 10 minutes and the moving average of 25 minutes. So the same colors apply from the previous charts. The moving average for the 10 minutes, the short term, is red color. The moving average for the long term is green color. And we have the Bollinger bands with the black colors and distance in between, or the middle point in between, with the orange color. So on the screen right now you can see the same graph, but here we have issued 3 different trades, both starting with a long position and ending with a short position, and you can see that the profit is ranging from 11%, 17%, or even 0.09% and so on. So the last strategy in our today's discussion of scalping strategies is number 4, scalp at support and resistance. Support is simply where the price tends to stop falling. On the other hand, resistance is where the price tends to stop rising. So these indicators, they are linear in nature. You can see that they are represented using a straight line over an interval of time. So the idea here is very simple. Whenever the price falls below any of the green lines here represent the support lines. So we issue a long position. That is, we are going to buy the stocks at a very low price and then wait till the price intersects the red line, which represents the resistance, and that means that the price is not going to rise again, stop rising, and that will indicate an exit of the trade or a short position. And when we exit the trade at this point, we have made a profit by using the difference between the support and resistance lines. So now on the screen you can see the same graph, but we are issuing here the long and short position rectangles. We have issued some of the trades based on this strategy at support and resistance positions. Now we have arrived at the apex of this course, which is the evaluation matrix Sharpe ratio. Sharpe ratio is one of the most important and most common evaluation metrics in the world of investment and algorithmic trading. And in the next slide we are going to discuss how it works and how to interpret its results. So Sharpe ratio was postulated by William Sharpe, an economist in the 1960s. The Sharpe ratio, symbolized by S in this equation, is the ratio between the expected return and the risk. Remember that with higher risk there is higher opportunity, but also this should be related to the expected return.